we're looking at a scenario where rates are going to come down, right? Economy is doing relatively well. We'll probably end the year at about 4.3% GDP growth. So the growth is decent, right? There'll be a few tax incentives given here and there, but also if you give something, there'll be tightening from the other end, right? So the government will ramp up its collections because our tax compliance is only about 50 to 60%. So if they improve on tax collections, which they have already started on, then to be honest, the incentives given can be covered to a larger extent by the collections as well, right? Plus, if vehicles are going to be allowed, vehicles used to be about $1 to $1.5 billion of imports every year. Even if it's a smaller amount, the collections from vehicle taxes will cover up for some of the shortages, right? So in a scenario like this, what are the investments or what investment asset classes should you be looking at right now, right? So from a fixed income securities perspective, treasury bonds, treasury bills, debentures are the most attractive ones, followed by unit trusts and equities. Let me go into a little bit of detail on each of them, right? So if you look at the bank deposit rates right now, bank deposit rates are hovering at about 7.5% to 8%, right? Whereas a 1-year T-bill is between 9.5% to 10%, right? So you have a 2% premium above the bank deposit. And now we know that a treasury bill is a risk-free instrument, right? So a bank deposit is a risky instrument, right? Because there's corporate risk involved. But treasury bill, potentially with Sri Lanka getting out of a debt crisis, the treasury bill will be a risk-free instrument, right? And the risk-free instrument at the moment is trading at a higher rate compared to the bank deposit, right? So that anomaly is temporary and will adjust over time. So these rates won't stay for long. So we believe you should look at locking in these rates when they are higher. Right? Also, when you look at an 8% rate, after you pay taxes, potentially if you're earning more than 300,000, you'll end up paying 36% on your interest income as well, right? Which will mean that you're only making about 5% interest rate net to your hand, right? 5.12% net interest rate and your inflation is at 5%, you're only making only about 0.95% as real return, which is not enough, right? So an 8% FD return doesn't cover up for the risk that you're taking, or not covering up for the inflation risk that you're taking. And even more than treasury bills, the more viable option is the treasury bonds, right? Now, treasury bonds, for example, the 5-year is hovering between 11.85 to 12%, right? Versus the FD, which is at about 8%, right? Also, we know that rates are going to come down, so we would want to lock in the rate at these levels for the next couple of years, particularly if you have money which you want to lock in or which you can afford to lock in for a long period of time, right? Treasury bonds also are risk-free, right? And you also have the possibility of making capital gains when rates come down in a treasury bond. And the good thing is that if you make capital gains, you only pay a 10% tax on the capital gains as an individual, right? Also, we know that the risk premiums attached to treasury bonds will keep coming down with the election risk and all that kind of being eliminated, right? So this shows the interest rate premium between of treasury bonds versus the policy rates. So compared to policy rates, what kind of a premium did bonds trade at, right? So if you look at the premiums fell down to about 2%, 2.5%, somewhere close to May 2024. At the moment, the premium is somewhere close to about 3.5%, right? So this premium needs to start adjusting downwards, right? Because treasury bonds shouldn't typically trade at such a big premium to the policy rates, right? So this is why we expect the bond rates to even fall further. Right? The other way that you can lock in rates is entering into debentures. We saw a few bank debentures. I think there are a few finance company debentures also coming up. Normally, debentures trade at about 50 basis points to 1% higher than the treasury bond rates, right? And now you should have avoided treasury debentures in a period where the economy is not doing well. But now with the economy doing relatively well, the corporate risk is reducing, right? So it makes sense for you to take on a bit of risk in terms of debentures and so on, right? Because the premium is justified in terms of what you're paying versus what you're getting on a similar kind of fixed deposit. Debentures are issued by corporates, right? And they are normally at a premium to the treasury bonds, and they are long-term instruments. So if you lock in at 12%, let's say, for example, you get that 12% for 5 years every year, right? So it's another product that you can look at. Depends on how many issuers come up with debentures. But at the moment, given that corporate credit risk has reduced with improved economic conditions, debentures are also an attractive asset class. The other two products that we would look at is unit trust and equities, out of which unit trust, CAL has two main unit trusts, which is what you call the fixed income opportunities fund and the investment grade fund. The fixed income grade opportunities fund gives a rate of about 12%, while the investment grade instrument fund gives about 10.5%. The benefit is that we've been able to lock in good rates when rates were high, and also you have the flexibility in terms of taking in money in and out when you want to, right? So you have the liquidity option as well. So you can use it as an alternative for your savings deposit, right? So unit trusts, given the flexibility and given that the rates are still holding high and at almost about a 3-4% premium to bank deposit, it is an attractive asset class. The benefit comes from being able to, the funds being able to time markets better, being able to lock better, and also get into products which normal citizens won't be able to get into, right? So that's how the yields have been relatively better. And we've been seeing these cycles for a while, which is why we kind of locked in when rates were on its way up. We kind of tend to lock in more instruments at higher rates. And when rates actually coming down, we actually benefit from being part of, or being, because we are already invested in high yield instruments. Right? I think I've explained this before, but the unit trusts also have a tax benefit because you only pay taxation on interest when you realize it. So if you have a need where you don't need the cash flows coming in every year, right? You just want to put away your investments. By keeping the money in a unit trust, you can postpone the realization of income, right? By postponing the realization of income, for example, in year 5 only, if you keep your money in a fund and only withdraw it in 5 years' time, in the 5th year only you have to pay your taxes, right? So that there is a saving on your taxes because of your time value of money impact, right? In FD or so, what happens is every year when you get the interest, you will pay the tax on that particular year. Here what happens is, because you're postponing the realization, right, you only pay effectively taxes as at year 4 or year 5, or when you really want to redeem your investment, right? So because of this, there is a tax advantage when it comes to unit trust investments, right? So unit trust investments still are an attractive asset class. So in terms of order of priority, I would think treasury bonds, unit trusts, and treasury bills to a certain extent, right? And a bit of exposure to equities. Now, equities tend to do very well when rates are coming down, right? And that's what we've been seeing. Rates have coming off, and the market has been going off. And this negative correlation has been proved throughout the years, and in a global context also, we've seen this negative relationship between interest rates and markets holding. Also, the turnover has been healthy. We've seen market participants actively trading. The turnover has been building up as such. And foreign buying has also been coming in, right? So typically in countries which complete an external debt restructuring and so on, there is a flow of foreign money that comes into the markets, right? So we have that possibility that Sri Lanka can or may also see some foreign money coming into equity markets after completion of the external credit restructure. Right? However, we also need to keep in mind that the market has moved quite fast in the last 2 weeks. So your RSI is close to about your 80 levels, right? So you need to be a little bit cautious in terms of going aggressively into the equity market, right? And also the market PR is still at about 8 times, which is not very cheap, right? So what can drive the market up is corporate earnings need to continue, and foreign buying needs to continue for the market to maintain this kind of momentum, right? So there is a likelihood that markets can go up, right? But we wouldn't recommend going all into equities right now. So probably a 25 to 30% exposure of your entire portfolio can be allocated towards equities at the moment. Right? From an equities perspective, there are four main things that you need to look forward to. And all of these four might be positive for the equity markets, right? So one is the parliament elections, and if the parliament elections end up with the same party which wins the parliament and the presidential elections being the same, then the markets will take it positive. And most likely the external debt restructuring will be completed, which means that foreign money can come in. So that is also a possibility, and we're expecting this announcement to come towards December, January, and the exchange of the bonds to happen in somewhere around March. IMF tranche will happen somewhere around February next year. This will be after the budget or the government gives its revenue proposals. And after the external debt restructuring is completed, within a few months, you will see the credit rating agencies upgrading Sri Lanka's credit rating from residual default. So there are few positive events which can trigger the equity market further. Plus, when rates start easing off a bit, you might see the equity markets doing well. Right? So just to summarize, overall, we haven't seen a policy change. Right? So do you think rates will go up? No. Have the risk increased? No. Why? Because from a policy framework, we are following the same kind of economic policies, right? And these economic policies, and particularly with the acts in place, right, there is very little leeway for the government and the central bank to do drastic changes which will affect the economy, right? As a result, it should be positive for markets, both from an equity and debt perspective.